That's right. This is Insights from Africa, and we continue to take a look at African debt on this episode. Ahead of the break, we delved into the high cost of capital. And while that is certainly something that needs to be addressed for future borrowings, Africa still needs to find a solution for the debt pile it currently sits on. Some have suggested that this solution could lie in debt relief. I spoke to Kenya's former central bank governor, Patrick Njoroge, for his take on this. Let's take a look.
The high cost of capital needs to be addressed, but remember that will only affect the payments going forward. The trouble today is that the amount of the debt stock that a lot of our countries are carrying has become unbearable, meaning it is a heavy burden. And as long as it remains like that, if you project it, say, the next 5 years, or the next 10 years, it means that they are unable to do significant, let's say, investments for the social things I mentioned, but even things like climate or even investment in roads, etc. So in some sense, you can say they are defaulting on development. So basically, in order for them to, let's say, square the circle, there has to be a sort of a significant operation on the stock itself, not for all countries, but for those countries that are overburdened and in a sense where this has become a sort of a stumbling, a constraint on their development expenditures. That plus also reducing the cost of capital in the long term, those are significant pillars for us to unlock the development expenditures that are needed going forward. And there is a lot of discussion about that. And I think at this moment, it is clear that there has been a greater appreciation that debt relief will need to be part of the equation. How that happens, there's less agreement about. But I think the point is, at least now there's more discussions about that, particularly in the context of the G20, and which, as you know, the presidency is with South Africa, and they're making this point that it should be part of the as needed as one of the pillars for our improvement in the development space.
You highlight this being talked at the G20 level. And often, as is the case when it comes to Africa, there are these very bad narratives that get put forward. And often debt relief or even the high cost of capital, when it's discussed, it's almost discussed in a way that this is charity for Africa. How do we then move the conversation from this is not charity, but this is actually an investment in prosperity? Because what happens in Africa affects the world, right?
That is correct. So I think you're right. The narratives, the bad narratives, are put forward often by people who are not interested in moving forward with debt relief. Now, obviously, there has been some, let's say, those bad narratives. There are some examples that one can say that fit the narrative. And part of, the background behind that bad narrative is that, yes, there's some, when we had the debt relief 25 years ago, the context of HIPIC, etc., it is true there are some countries that misused the space that was provided. But on the whole, actually, the record will show that on the whole, most of those countries did well in terms of improving on growth, which was the on poverty reduction, which was the focus. So they did spend their whatever space was created on poverty reduction mechanisms, etc. So the narrative, we have to address it head on by actually creating a positive narrative and really repeating that positive narrative. And the narrative that actually, the realistic narrative, is what you suggested, that actually it's not charity. To begin with, it is clear that some of the discussions, or let's say some of this debt that was contracted was actually contracted at extremely sort of very high terms, and exorbitant terms, and that has to be dealt with in a sober way, right? But secondly, creating space, as debt relief would, creates the space for development, which is something that the entire planet will benefit from. So the mere fact that other countries do better should be something that is applauded by all the countries around the table. So in some sense, these collaborative outcomes and outcomes that really benefit others, that is something, the externality from that is something that I think we need to look at significantly. Thirdly, Africa, as we look forward, the world is becoming African. Meaning in 25 years, more than a quarter of the labor force will be in Africa, just looking at the population dynamics. So it's about time that we spent effort as a people in training and developing the people that are here. So in terms of health, in terms of education, in terms of economic opportunities, all that needs to be done. The focus should be Africa for the world. Now, if you remember, after the Second World War, there was a focus on Europe. I mean, and everybody, meaning the Americans and others, and it was America that was the leader then, did focus and spent a lot of money on the Marshall Plan, etc., even though Europe is over on the other side, because it mattered for the entire world. And I think we are at that moment, and we have to acknowledge that actually, this is as critical a moment as we had back in 1945.
Well, Patrick, mentioning the critical moment that we're facing right now and taking that further, as the globe is gripped with nervousness around tariffs, a shining light for Africa has been the African Continental Free Trade Area, because it could open up new markets for those on the continent. But to get that off the ground, considerable investment needs to be made in infrastructure. And governments can't do that, one, if they cannot access capital at affordable rates, and two, if billions of dollars that could have been used to build railway lines, for example, are instead being funneled into servicing debt. And so in this way, the real impact of the high cost of capital is being felt today. For his take on this, I spoke to Lutando Vuba, who's the executive head of international trade at Standard Bank's Business and Commercial Banking Unit.
The biggest thing that's a concern around the tariffs is the impact it has to some specific value chains that have been concentrated in supplying into the U.S. in particular. Less so the tariffs, but then the removal of AGOA, because what the tariffs, the announcements have done, they've sort of superseded that. So you have impact to textile and auto value chains. But then when we're trying to think about those value chains or those businesses that are supplying into those manufacturers and the manufacturers themselves, we look at alternative market access, and we talk the African Continental Free Trade Area, even in the regional economic communities, we're talking about the immediate opportunities there, certainly, and the free trade area allows for it to be, even more incentivized to consider it. However, the infrastructure that's required to really make it easy and cost effective is not in place. We have a concentration of 80% of goods on the continent moved by road. That is considerably more, probably your most expensive option to move goods. Rail is probably your most optimal. We have air and we have maritime. So if we look at where those are and how optimal they are for movement goods, it's really the impediment on why we are not seeing more intra-Africa trade, and currently sitting around 14 to 15% of Africa's trade when you compare it globally. So the cost of capital is a key then inhibitor in what currently African markets experience. OECD countries on average from their budget account for around 6% of their debt servicing. African markets, that is between 17% and 50% of their budgets. So when we have to think about African governments are looking at is, one, they do not want to default, because of the impact that the impact that would further have on the sovereign and wherever the risk grade is. So you're having them having to weigh up against priorities then of, servicing the debt and what remains, then look at the other priorities. And then furthermore, when we look at then those risk grades that are applied to African sovereigns, our research indicates that on average there's about 4 rungs lower than what they should be pegged at. And that directly impacts, the premium, the risk premium that they have to pay that debt at. And remember, they're servicing this debt in foreign currency. So it is also impacting forest reserves that we need for import. So when you're talking about developing the roads or the infrastructure for railway, or just, our manufacturing capacity, there's quite a bit that needs to be imported to industrialize. And that also directly impacts the African sovereign's ability to then pay for imports. So practically, when you outlay, that's how all of this ties back to the cost of capital topic. And I think that's one aspect that's really directly impacting on that. However, through this process, there's quite a number of good ideas that is looking to how do we address that, how do we look at alternative ways of financing, right? From private capital, pension funds, better role played by DFIs and your multilateral development banks when it comes to risk and playing within the mandate of taking the risk on that value chain of those projects, better preparation of investable projects, making sure they're investable. We have around 90% failure rate of projects just at pre-planning stages. So those are some of the practical elements. And in addition to that, we have in South Africa, but broadly for the continent, it will be good to be institutionalized. The public-private partnership in South Africa, we have a policy around it. That will be institutionalized and create room for the participation of philanthropic capital. And really looking at blended finance and this, what we have come to call now not the triple P, but the quadruple P, that includes philanthropic capital being sort of alternative mechanisms that can help with financing infrastructure. And I really see those being some of the mechanisms that can help us deal this issue.
And that brings us to the end of this episode of Insights from Africa. But if you want more content like this, or if you want to rewatch any of the discussions we've had on the show, you can find them on the Business Day TV YouTube channel under the Insights from Africa tab. And if you follow us on social media, you can stay up to date with all our content as well. So be sure to find us on X, TikTok, and LinkedIn. But for now, from me, Bronwyn Seaborn, and the rest of the team, it's goodbye for now. Insights from Africa is brought to you in partnership with Standard Bank.